Hello everyone. I would like to give you a brief introduction to the Think Finance Portfolio Manager, which is a toolbox for prototyping, analyzing and optimizing investment ideas. Now, the easiest way to give you an introduction is to guide you through an example. So let's assume I'm a Eurozone investor and I'm currently only invested in Eurozone equity, which you see here. And I would like to diversify my portfolio into US equities. Let's assume I'm a risk-averse investor, so I'm looking for low volatility solutions. In the following, I will structure 3 potential investment solutions, which I will set out in 3 different books. The reason is that in Portfolio Manager, it is very easy to compare the risk profile and the backtests of different books. Now, the 3 solutions I want to propose is, first of all, a simple ETF. Secondly, a risk-optimized portfolio that I will construct myself. And thirdly, a structured product. So let's start with the ETF. So I'm going into the ETF Navigator, which is a toolbox of over 10,000 ETF listings, and it offers a variety of risk analysis and performance analysis functions. So because I'm a risk-averse investor, I'm looking for a low vol ETF as a keyword, and I'm looking for ETFs listed in US dollars. And I also want to make sure that the ETFs have a minimum track record of, let's say, at least 2 years. So after setting these search filters, I click on the search button and these ETFs here appear. Now, I'm a very cost-sensitive investor, so I want to look at the cost side of these ETFs, which means the total expense ratio. So the first thing I do is I sort this table according to the total expense ratio. So the cheapest ETFs are on top. Let's take a closer look. We have here a Russell 1000 low vol ETF, an S&P International Developed ETF, and an S&P 500 low vol ETF, which looks interesting. So let's look at this one here. I double click on it, and here's the history of this low vol ETF. Now, because this is an S&P 500 low vol ETF, I would like to look at the corresponding benchmark. So let's select the S&P 500 and add it to the performance chart. If I want to know the tracking error, I click on the information button and I see the tracking error of this low vol ETF is 0.43%. Information ratio is very close to 0, so the performance is very similar. But what about the risk profile? If I click on the valued risk distribution button here, I see that in fact the valued risk of the low vol ETF is in fact lower than the benchmark as expected. I can also look at the risk return chart and I see that the return is close to benchmark, very similar, but the volatility is much lower. So I kind of like this ETF. It's the Power Shares with a symbol SPLV, and I want to use this as my first potential investment solution. So how do you create that? So I'm going to the Trade Manager, which is the tool to enter all types of securities, including derivatives. The asset class is equity. The type of security is ETF. The symbol, I remember, was SPLV. It's down here. And let's assume I want to invest $50,000 into it because I'm currently invested in the Eurozone with 50,000 euros. And I'm setting this out in book number 2 because book number 1 is the Eurozone equity. So now that I input all the parameters, I click on the search data button, which uploads the market parameters. And if I click on the OK button, here is my ETF. Now let's give this one a name also, this book. I can do that by double clicking on it. This is the book box, and I can enter the name of this book, and I call it US Low Vol ETF. Now let's compare the risk profile to my existing Eurozone equity. I can do that by clicking on the risk manager here. Now this is the joint valued risk distribution, but what I'm interested in is the comparison of the valued risk book by book in percent of the market value. And it's interesting to know that my US low vol ETF already has a lower valued risk than my Eurozone equity. Well, the question is, can I do better than that? Let's try. And this is my investment proposal number 2. I'm trying to create my own low vol portfolio in the portfolio builder. And what I will do is I will use the components of the Dow Jones Industrial Average, which is an index with 30 components. I will use these 30 components as a starting point. So I'm selecting these 30 components. I want an investment of, in total, $50,000 again. So each share will have $1,676 in base currency, which is US dollars. And I'm importing these 30 shares. And they appear here in book number 3. And I will call this one US Risk Optimized. Okay, and here is the third book. Now, I haven't done the risk optimization yet, so how do I do that? So I simply select this book and go into the Portfolio Optimizer, which is the tool to optimize portfolios. Now, in this case, I want to optimize at a position level, which means I want to optimize within a book and not across books. I also want to preserve the sign of each position because I don't want short positions. So these are the 30 components of the Dow Jones Industrial Average Index. And now I can run the optimizer to calculate the efficient frontier, which will appear in this panel here. Now all I have to do is to click on the minimum variance button to move my portfolio onto the efficient frontier. And in this table here, I see the existing portfolio and the minimum variance portfolio. If I want to change my current portfolio to the minimum variance portfolio, all I have to do is to click on Use Optimized Portfolio. Yeah, he reminds me that some positions will be 0, that's fine. And here it is. That's how easy it is to create a low vol portfolio, in this case even a minimum variance portfolio, using the Portfolio Optimizer. So let's compare the risk profile of these 3 books in the Risk Manager. This is again the joint valued risk distribution. Again, let's look at the valued risk distribution book by book in percent of market value. And I see in fact the US risk optimized is slightly more conservative, so has a slightly lower valued risk than the US low vol ETF. That's already good. The question is, can I do even better? The answer is yes, I can, because let's remember these 2 books are exposed to currency risk because I'm a Eurozone investor. My reporting currency is euros. So these books still contain US dollar risk. So let's try to hedge that to reduce the risk even further. How do I do that? I go to the Trade Manager and I want to trade an FX forward, which is in the category foreign exchange. FX forward, and I need to trade the euro US dollar currency, and I have to hedge $50,000. I'm choosing a 1-year maturity. The contract price, the fair value contract price, is calculated automatically, and I want to hedge the third book, the US risk optimized book. I'm clicking on this button to import the market data, and OK. Now, if I open this book, I will see here's the FX forward. Let's look at the risk profile now in the risk manager. Once again, risk book by book in %. And I see, in fact, the risk has been reduced even further. So I have a more conservative portfolio now than by using a standard use low vol ETF. The third option I want to consider is a structured product. So I'm opening the structured product factory, which offers a lot of different structured product templates. I can go through them here, and I see the payoff on the right hand side, and I'm looking for a conservative product again. I kind of like this one, the airbag certificate, because it offers some sort of downside protection, but it's not as conservative as a capital protected note, which is also more expensive because it offers full capital protection, whereas the airbag certificate is slightly cheaper, but it only offers partial protection, which is fine for me. So I'm selecting this one, the airbag certificate. Now, as an underlying, I want US equity exposure, so I'm choosing the S&P 500 as an underlying. The product notional is again 50,000 as for the other books. And I don't want currency risk, so I'm choosing the Quanto option here. I'm choosing a product that is denominated in euro, so it's a Quanto product. Now, after changing all these input parameters, I run the rules, and my product is finished. So I click on the OK button, and here's my third option, an airbag certificate. Let's look at the risk profile again. Again, book by book in % of market value, and I see indeed the airbag certificate has an even lower valued risk than the US risk optimized portfolio and the US low vol ETF. The next thing to look at is the diversification benefit of these solutions to my existing portfolio. So let's look at what is the diversification benefit between the Eurozone equity portfolio that I currently have and the low vol ETF. Well, all I have to do is to select these two, and I see the diversification benefit down here is 10.5%. Let's do the same thing with the US risk optimized portfolio. I select the two, the Eurozone equity and this one, and I see the diversification benefit is much bigger. It's 34%. That is not surprising because the US risk optimized portfolio includes a currency hedge. Last but not least, let's look at the diversification benefit with the airbag certificate, which is only 8.6%. Another thing to look at is, of course, a backtest of these three different investment proposals. So let's open the backtester, and all I have to do is to click on the backtesting button. And again, this is the backtest of the entire portfolio. But what I'm interested in is the book-by-book comparison, which I get by clicking on here. So here I see the backtest of the Eurozone equity compared to US low vol, US risk optimized, the airbag certificate, and a standard benchmark. What is interesting to note is to look at the backtest in terms of risk-return profile, which I can look at by using this function here. And I see the airbag certificate and the US risk optimized portfolio have the lowest volatility, but during the backtesting period, they had a lower return than the US low vol ETF. But the return was still better than my Eurozone equity portfolio. So all of them created a better performance. They have a lower risk and they offer diversification benefit, which overall makes all of these investment solutions worth considering. That is the end of our short introduction. As a final remark, it's interesting to note that instead of taking the Eurozone perspective, I could also rerun the whole assessment from the point of view of a British pound investor. So all I have to do is to change the reporting currency to British pounds. And I can redo all the risk analysis and backtesting analysis from the point of view of a British pound investor. That concludes our introduction. I hope you enjoyed it. If you want to know more about the Think Finance Portfolio Manager, then please visit our website on www.thinkfinance.eu. Thank you for watching.